Hey everybody, this is Ryan Mallory with SharePlanner.com, swing trading in the stock market. In today's episode, we're going to talk about setting expectations as it pertains to your swing trading. A lot of people have expectations when they go into it, and then those expectations are kind of blown up into smithereens when they actually start getting into the going from the paper trading to the actual trading itself with real money, and then the difficulty and the realization of that difficulty puts into doubt being able to ever achieve any of those expectations. So that's what we're going to talk about with that. And really, this podcast episode should allow you to walk away having a little bit more comfort with swing trading and not feeling the pressures of having to meet certain expectations. So for this episode, and I never use people's real names, I always use a fake Florida redneck name. For this episode, I'm going to call this person Betty because I don't want to use their real names. And the reason why I'm using Betty is because I took my boys to Waffle House for the first time just recently, and Betty was our server. So this is a shout out to Betty from the Waffle House for being an incredible server to us there. Man, she was on top of her game. I give her like a big tip. But by the way, who knew that Waffle House, you go to the Waffle House and it's like $50 for 3 people? I remember back in the day, I think I could eat for like $10 for 3 people. I mean, it's nuts. I mean, I could say the same thing about Denny's too. I mean, they used to have the $1.99 Grand Slam breakfast, and I thought that was great. But in any case, Betty from the Waffle House writes, "Hi Ryan, I love the podcast. I've been listening like crazy ever since I discovered swing trading at the beginning of the year. I've been paper trading for the last few months while I build up cash for an active account. I have lots of questions. Any or all I'd love to hear about on a podcast. I don't feel like I have," here's number one. "I don't feel like I have a good grasp on how many trades I can expect to take in a given week, month, or year. It makes me nervous when all I see is longs or shorts. Do you have a target ratio of long to shorts at any given time? My goal is to make this a profitable side hustle. But again, I don't feel like I have a good grasp on what my goals should be in terms of taking profits, win rate, etc. I'm sure you've already made a podcast on this. But I don't think I've listened to it yet. And finally, number 4, all I want to do when I enter a trade is stare at the chart all day until it makes a move. Any tips on being so attached to the charts? I do want to say that I understand the answer to a lot of this is it depends." That's an old economic statement, by the way. If you ask an economist what will happen, they'll often tell you it depends. I know that because I studied economics, and if you guys been around the stock market for any length of time, you've probably heard economists get interviewed, and they'll say it depends. But because they tend to not want to commit to one thing or another, they're usually always looking at various variables. In fact, I think Jerome Powell says it depends a lot. In any case, without getting sidetracked about that, Betty wraps up by saying, "I just wanted to open up the floor to you to hear your thoughts. Thank you, Betty from the Waffle House." Now, I like this particular question. It's been a long time since we've had a hodgepodge of questions, and here we got a ton of them to go over and answer. By the way, and I'm not trying to ramble too much, but forgive me for on the lateness in some of these podcasts here. Life has been really crazy of late. I've moved. My family moved. They all came with me, thankfully. Moved. That's always a pretty big endeavor, trying to pack up everything. And it wasn't even something we were planning on doing. Saturday morning drive, I told me and my wife, we were in the car. I was like, "Hey, you want to go look at this house that's for sale?" Sure enough, made a mistake of going inside, falling in love with this good old country home and buying it. So now the wife's talking about chickens and goats. And so that when that finally happens, that'll be some interesting life expansion into new endeavors. But doing that, and there's a lot of work to be done too on the place. But doing that, daughter just got married. That was pretty exciting. And I got to tell you, she asked me to walk her down the aisle, and I have to say that was probably next to marrying my wife and becoming a father. That has to be like right there at that level. I mean, it was just such an amazing moment. I know it's about her. She's walking down the aisle. I'm just escorting her down, but I couldn't get enough of it. I mean, it was just such a special moment for me. But in any case, I will get to these questions here now. So Betty, the first question Betty asks is, I don't feel like I have a good grasp on how many trades I can expect to take in a given week, month, or year. There's really shouldn't be an expectation. And this is not it depends kind of a thing. It's a matter of fact. you should not have an expectation for it. And really, it's market driven. How favorable are the market conditions? I've gone weeks without making a trade, and I don't really blink an eye at it anymore. Before, I felt like I was being lazy, and it wasn't necessarily because I was being lazy. Usually during those times, I'm doing more research and work than ever before, but it feels that way because you're not pulling the trigger on it. And in the trading block, sometimes I probably assume that people are wanting me to make more trades than I oftentimes do, but what's the driver there is that the market conditions are not favorable. So I was able to short the market on different occasions when the market fell during the April sell-off with everything tariff related. There got to a point when I covered those positions that I wasn't going to keep shorting just because the market was still falling. I had to wait for that market to provide a better opportunity, and it took a while for that to happen. It started to bounce, and I got a little action off of that initial bounce that day. I think we were up like 9%. I got into SPY before it made that move, and all of a sudden I'm like, whoa. I think he made some comments that the market really liked, and it changed the whole narrative on the market, put a bottom in, and it was off to the races from there. But you have to wait for those moments. The market doesn't always afford them, especially in the bearish markets where the volatility gets really high. You should be trading less in more volatile markets. And the reason why I say that is because the volatility is high. You don't need as many positions to be able to make a return. And the more positions you have in a highly volatile market means the more fluctuation there is going to be in your portfolio. And really, yes, you can make a lot of money, but you can lose a lot of money. And you don't want to be just being tossed about. And because in bear markets, there's going to be, rip your face off rallies, and there's going to be just absolute insane sell-offs that make you think that the world's ending. And you don't want to be heavily hit when you're on the wrong side of one of those moves. So doing less with more, doing more with less. I almost bungled that one up. Doing more with less is the key in a bear market. You want to let your positions, a smaller amount of positions, do the heavy lifting. So in a bear market, I may only have like one or two positions. In a bull market, I can have 5, 6, and just recently, I think I had like, I don't know, it's like 9 or 10. And so you really want to make sure that in the bear markets, you're not, cash is a position. And a lot of people don't agree with that, but it truly, truly is, because it shows the confidence that you have in the overall market. So in a scorching hot market, yes, I'll have a lot more positions. I'll have less of my cash on the sidelines. In a market where there's more questions, or where we're starting to pull back and things are starting to look iffy, I might scale that back somewhere. The stop losses will dictate that I have to scale it back some. And so then my overall position is not as large in terms of equity exposure as it was before. The other thing that helps to drive that is that a lot of my trades, breakouts and so forth, will not be validating. They will not be triggered into an actual trade. And so when that happens, I'm not taking positions either, because they're selling off rather than rallying. So much of your portfolio success is going to be hinged on the overall market conditions. So if it's a poor market, most of your positions are likely to go down. In a good market, most of your positions are likely to go up. The influence of the overall market on stocks individually is huge. And so skipping down to what question was it? He asked here, number 2, he says, it makes me nervous when I see a lot of longs or just a lot of shorts. Do you have a target ratio? I don't usually have a ratio of stocks. There's times where I could have some long positions and equities, and then I have like a short on the SPY. That's possible, but usually that's like a transitional phase where I'm starting to shift from being bullish to bearish, and just one of my positions hasn't been closed out yet. But what I would say is that my cash position is going to dictate how bullish I am. So it's almost like it's really an equity to cash position ratio that I'm talking about. And I may be like 90% long, 10% cash in a very strong bullish market, and when things are starting to get a little bit leery, I may only be 40% long, 60% cash, and then when the market starts selling off, I'm doing less with more. Or I'm doing more. Keep messing up on that one. I'm doing more with less. So I may be like 30 or 20 or 30% short, 70% cash, but I don't think you'll ever hardly see me get 100% short. That's just not likely to ever happen unless we're just in this really prolonged, extended sell-off where the shorts are just continuing to sell off. And at that, we haven't seen that in a long time. So you look at the March 2020 sell-off, what was that? Like 5 weeks? You look at 2022, that was a pretty long extended sell-off. But then the one that we had this year in 2025, that was maybe a month. So you don't get, when you're short, you want to assume that the whole world is working against you to make you wrong in your outcome in your trade. That's when you're short, because everybody wants that stock market to go up. The politicians do, the Federal Reserve does, the powers that be, the hedge funds, the institutions, Wall Street, they want the market to go up. So when you're short against, not only against the market, but you're short against the world too. So assume that there's going to be some nasty dead cat bounces. Even if they don't hold, could still rock your portfolio and ultimately stop you out. So be aggressive about taking profits in a bear market. Also, going back to number one, that when he was talking about he doesn't know how many trades that he should be making on a regular basis, I would say don't chase the numbers. Don't feel like you have to make 5 trades. And this is kind of expounding on what I talked about earlier. Don't feel that you have to chase those kinds of gains. Don't feel that you have to chase a certain number of trades every single day or every single week. People do that and they say, I'm going to make 5 trades a day. But then if you're able to make 2 and your goal is to make 5, but the trade quality is not there to justify trade 3, 4, and 5, what are you going to be doing? You're going to be justifying trades that you shouldn't be getting into. And so then all of a sudden the quality of your trades goes down. So don't set numbers for that. I would say in a given year, I probably make about somewhere between 140 to 200 trades per year. That's about it. Not a ton. I think probably this year it's a little bit less because there was a large waiting period there when the market was selling off, and then sometimes when the market rebound was in question. Number 3, my goal is to make this a profitable side hustle. But again, I don't feel like I have a good grasp on what my goals should be in terms of taking profits, my win rate, etc. I'm sure you've already made a podcast on this. I probably have. I mean, I've talked about a lot of those things at length, but I don't think it's bad to repeat, because one, if you've already heard it before, it's good to reinforce those questions, those thoughts, because you may have forgotten about it. And 2, if you may not have gone back and listened to previous podcast episodes, so I don't really mind talking about it again. But before I do that, make sure to go to shareplanner.com and check out the SelfMade Trader. This is my flagship course. This is going to teach you everything that I know. It's over 25 hours of video instructions from me personally, and I filmed it myself, I edited it myself, made sure it was exactly the way I wanted it. Even the write-ups and the questions and the activities that go along with it was all designed and done by myself as well. It took me about 4 years to build this. You can literally see me age from beginning to end. I don't know what happened in the last 4 years, but I definitely aged. I guess I got older. But check it out, the Self-Made Trader. Go to shareplanner.com, click on the Academy at the top, and check it out. I think you'll like it. I think it'll revolutionize your trading. And let me know if you have any questions about it too. You can email me, ryan@shareplanner.com. So number 3, again, the question was, my goal is to make it a profitable side hustle. But the win rates, the position, the rate in which you take victories at is in question for them. Well, that all comes down to the reward risk ratio. How many dollars are you making for the amount that you're risking? So if you're only making $1 for every dollar you lose, you need to have a higher win rate than 50%. I always aim for 2 to 1, try to make at least $2 for every one. That means if I'm 50% right, and I think historically I'm about 57% right, I'm going to do much better than on a regular basis. So if I'm making 2 to 1 and I'm winning 50% of the time, I'll have a good win rate. I don't really worry too much about how much money I think I can make on the trade. It comes down to the reward risk ratio. So sometimes it may be a slower moving stock. Let's say I'm getting long on TLT. I don't even know what trades at it these days, but let's just say $100 to keep it simple. And I'm getting in at $95. Or I'm getting in $100 and putting my stop loss at 95. Well, if I only think that it can go to 105, that's really not the best reward risk ratio. It doesn't fit my profile. That's a 1-to-1 reward. But if I can say, okay, I think it can go to 105, and I think there's a clear level of support at 97.5, I'll take that trade all day. It's not as exciting of a trade, and I'm not getting caught up in the dollars. I'm just simply looking at it from reward risk ratio. And, whether it's a stock that I'm taking a 5% risk or a 7% risk on versus one that I might be only taking 2%, and the reward risk ratio needs to be the same. Now, trying to hit that reward side of the equation gets much more difficult the larger the stop loss is, because you need a bigger move from the market to be able to justify that trade. So you take, for instance, a trade that requires a 20% stop loss. And I don't trade stop losses with 20%, but let's just talk about that for a second. If you do that, then you're looking at having to have a 40% return on your trade, or else you can't really justify that. Yes, if it hits 40%, that's great. I mean, that'll cover up a lot of bad trades. But if you're wrong, you just took a 20% hit, and let's say, you're putting 20% of your capital down on the trade. Okay, you just took a 4% loss against your overall portfolio. That's a pretty significant hit, not really one that I want to try and recover from. So it all comes down to, now I'm not against people making 40% on their trade. That's great. I've done it before. It's wonderful, but it comes because I took a pretty small risk, and so that reward risk ratio multiplied by tenfold. And instead of taking, a 4% loss, and making it, or an 8% gain, I ended up getting like a 40% gain, and only took at the expense of possibly taking a 44% loss. So it all comes down to that reward risk ratio. If, let's say, your reward risk ratio is 10-1, you don't need a 50% win rate. You could probably get by with probably like a 15 or 20% win rate. I mean, it just all depends on the reward ratio, risk reward ratio. Number 4, all I want to do when I enter a trade is stare at the chart all day until it makes its move. And he tips on not being so attached to the charts. Yes. If you're a day trader, you should be attached to the charts because you're looking to make moves very quickly. But swing trading is a multi-day process. I tell people my average swing trade goes from a couple days to multiple weeks. At best, it goes 3 months. And that would be that I got in the day after its earnings report and sold before its next earnings report. And that rarely, if ever, happens. But it's not uncommon for me to hold a stock for a month or 2 months. And it's not uncommon for me to get stopped out within a few days. I like to lose fast, win slow. So what doesn't make much sense is for me just to stare at the screens at a specific chart all day long. That means I'm probably, one, trading with too big of a position size because the outcome matters far too much and I can't take my eyes off of it. Or 2, I have the wrong expectation for that trade that I think I'm supposed to get rewarded right away. I mean, I have a trade that I've been in, GTX. I think it's a roller coaster intraday. And if I am constantly staring at the charts, I'm going to be making decisions based on these intraday moves when the trade's really about a multi-day process. So you have to look at it from a multi-day time view and not just at the moment, oh crap, it just dropped 10 cents. I'm getting out of this thing. Something's wrong. No, that's just an intraday move. That's just noise. So you don't want to get caught up in having to watch these charts all the time. Again, if you're scalping or if you're day trading, yes, you got to watch the charts. If you're swing trading, no. That doesn't mean that you don't watch it throughout the day. I watch my charts and I look at my stocks all throughout the day, but I'm not glued to one particular one. I'm just not staring there expecting at any moment it's going to move. Now, it can move, and it can move against you. I had a trade just recently, Applied Materials, AMAT, and got downgraded. So I made a quick move to the downside. I took like a 6% loss, I think, on the trade. And I think that was one of my worst losses in the last few years alone. And that stunk. But there was nothing I could really do about that, and it hits my stop loss. That's why I talk about stop losses, because if the stock does make a sudden move and it goes against your interests, you want that stop loss to kick in, and you're out of the trade. So hopefully I didn't give you anything that just felt like it was a it depends answer. I thought these were all good quality questions from Betty at the Waffle House. And one of the things you got to remember is, setting expectations, the number of trades or how much money you're supposed to make or how often you're supposed to win. When you're setting expectations that are not rooted in anything market related. The only thing that I would say is that win rate needs to be a certain percentage when you're looking at your reward risk ratio. And when it comes to the frequency of your trades, you can't push the trades. You got to let the market bring that to you. And that also goes for the long short ratio, or what I like to call the long cash ratio, because the amount of cash that you're holding in your portfolio should be a reflective of the overall conditions of the market and your confidence in them. If you enjoyed this podcast episode, and I hope that you did, please make sure to leave me a 5-star review on whatever platform you're listening to me on. If you're on YouTube, make sure to like and subscribe, and let me know down in the comments below what are some of the expectations that you have that you struggle with personally. I want to hear about those. I also want to hear from you as well. Send me your questions so I can make a podcast out of it. I tell people all the time I don't get enough emails from listeners, and I want to hear from you guys. If you have a whole bunch of questions, you can't narrow it down, just shoot a whole bunch of questions out of it, and we'll do like what we did for Betty here and make a podcast episode out of it. Meantime, check out the SelfMade Trader at sharepointer.com. That's going to be my flagship course where you can learn everything that I've learned over 30 years of trading. It takes you from beginning strategies all the way through advanced strategies. Really, really cool stuff. Think you'll like it. Thank you guys, and God bless.